start the recording. And there we go. All right. Hello, everyone. Welcome to this week's installment of the Microstructure Exchange Emerging Scholars Month. We have Chaojun here with his work, presenting his work, sorry. And before I yield the screen to him, I was hoping to make one announcement, and that is a new call for papers from NBER. And this will be a conference, a virtual conference that will be happening in December on big data and securities markets. And it's being organized by Itai Goldstein, Chester Spat, and Mao Ye. We will send a larger announcement in this week's distribution. But those of you who would like to take a look at the call for papers now, I will send a link through the chat window. And I'm not using the Q&A window because I don't have access to it actually as a panelist. So click on the link that will pop up in the chat window in just 1 second if you're interested in taking a look. This is it in terms of organizational announcement. The only thing that I wanted to make a quick reminder about is that we switched back to that older format that we were using in May and June, whereby the speaker pauses a couple of times during the presentation to answer your Q&A questions. So if you have questions, please type them into the Q&A window. Please feel free to upvote each other's questions if you find them interesting, and I will read them to Chaojun as he stops during the presentation. This is all from us. Chaojun, thank you so much for coming again, and please take it away.
Well, thank you, Andre. Thank you, everyone, for being here. It's a great pleasure to be able to present to this audience. So this is joint work with Junyuan Zhou from INSEAD. He's also online now, I believe, and will help answer some of the questions in the Q&A panel as we go along. All right, so we'll get started. So, all right. So the classic adverse selection effect predicts that a more informed trade tends to get worse pricing, simply because the dealer or the market maker is more likely to be adversely selected by an informed trade. Now, this pattern, there are some empirical work that shows that this pattern can be reversed in some OTC markets. For example, in the foreign exchange spot trading markets, there are some empirical papers that show that a more informed trade tends to get better pricing, not worse pricing. So what we show is that this is possible when dealers in the OTC market chase informed orders by offering narrower bid-ask spread, and so as to better position their future quotes in subsequent trades. And this is how it works. 2 Sigma, which is a top hedge fund, approaches 2 dealers in the OTC market, Goldman Sachs and JP Morgan, to request a 2-way quote to trade a certain asset. Now, let's say that the current expected value of the asset is 100. So both dealers will quote a mid price of 100. Now, because of the fear of being adversely selected by 2 Sigma, both dealers will tend to charge a bid-ask spread to cover the adverse selection cost. Now, let's say that the bid-ask spread to be charged is $2, which is just enough to cover the adverse selection cost. So that both dealers charge now an ask price of 101 and a bid price of 99. So that the spread is $2. Now this is the Gloston-Milgram spread. Now when the dealers charge this spread, both dealers are going to be break even, regardless of whether 2 Sigma wants to buy or wants to sell. Now let's imagine what happens if Goldman Sachs tries to narrow its bid-ask spread to attract 2 Sigma's order. Now why would Goldman want to do that? Now if Goldman execute 2 Sigma's order, then Goldman can learn from the 2 Sigma's desired trade direction, whether the asset is more likely to be good or bad. So for example, if 2 Sigma chooses to buy from Goldman at the ask price, $100.5, then Goldman learns that the asset is more likely to be worth more than the expected value of $100. And subsequently, when liquidity traders approaches Goldman Sachs and also JP Morgan to request to trade, then Goldman would naturally adjust its mid price from 100 to 101. Now, so Goldman Sachs will post an ask price of $101.50 and the bid price $100.50. Now, JP Morgan didn't observe the first trade in the first place because this is an OTC trade. So JP Morgan lost the bidding war and failed to trade with 2 Sigma and doesn't observe the trade direction between 2 Sigma and Goldman Sachs. So he didn't learn anything, whether this is more likely to be good or bad asset. So he will continue post a mid price of 100. Now let's say that he keeps the same bid-ask spread, 99.5 and 100.5 for ask. Now what's going to happen? For liquidity traders, they trade for liquidity reasons. So some of them wants to buy, some of them wants to sell. The simplest assumption is to say that half of them wants to buy, half of them wants to sell. Now, given these quotes, then Goldman Sachs is going to attract all the sell orders because his bid is higher. And JP Morgan is going to attract all the buy orders because his mid price is lower. Now, this is bad for JP Morgan because the asset is more likely to be good. We know that from the trade of 2 Sigma. 2 Sigma was informed he wanted to buy. It's more likely to be a good asset worth more than 100. However, he is left over with all the buy orders, and he basically sold a lot of the asset. On the other hand, Goldman Sachs attracted all the sell orders, and he bought a lot. And this is winner's curse, basically. Goldman Sachs, being more informed than JP Morgan, posted more informed quotes and left JP Morgan with most of the undesired buy orders. So Goldman Sachs, despite losing on the trade against 2 Sigma, because he shrinked his bid-ask spread, he make up the loss later by trading with liquidity traders. By the way, this is not what's going to happen in equilibrium. This is just an illustrating example to show you how order chasing works, how chasing information works, and how this will give both dealers the incentive to chase 2 Sigma's order at the first place by narrowing their bid-ask spread. In equilibrium, I want to show that the bid-ask spread posted by both dealers to 2 Sigma will be narrower than the Gloston-Milgram spread. And we are going to show you when this incentive to chase informed orders can dominate the fear of adverse selection. And the purpose of this paper, in addition, is to provide empirical guidance as to how to find empirical evidence of information chasing in the OTC market. So more specifically, we show that on a multi-dealer platform with direct price competition in a benchmark model, we show that dealers' incentive to chase informed orders exactly offsets their fear of selection. So there is this, this is the knife edge case where the two forces magically offset each other completely. As a side product, we show that when there are more liquidity traders, price discovery improves. Now, this is a very natural result to get to imagine. However, we cannot get that result easily in traditional trading models like Gloston-Milgram, Kyle model, or the Vives 2011 paper. And also we show that there is a price dispersion that would arise from this multi-dealer trading platform, and more specifically from the winner's curse that I just mentioned a moment ago. And when there are more liquidity traders, price dispersion would also increase. I'm going to come back to this in just a minute. Now, this is a benchmark model where we look at what happens on a multi-dealer platform. Now, more generally, we look at more general trading protocols, not necessarily on a multi-dealer platform. We show that information chasing can actually dominate adverse selection in the sense that a more informed trader can receive tighter bid-ask spread from dealers relative to a less informed trader. Now, empirically, we show that the evidence of information chasing in OTC market can be found only across traders, not within the same trader. So this is kind of the guidance to where to find the empirical evidence. And lastly, in the extension model, we show that on multi-dealer platforms with direct price competition, an information monopolist would arise as a result of information chase. So there are a lot of classic work on adverse selection in over-the-counter markets. Here are the classic ones. Now, let's be clear. We're not trying to overturn this classic literature of adverse selection. Instead, what we are trying to do is that we are trying to, in a more general framework, trade off the effect of two countervailing forces, one being adverse selection, the other one being information chasing. And we want to show we want to provide conditions in which one dominates the other. Now, for example, the Kao 1985 model in this more general framework can be viewed as a special case, which we will predict that indeed adverse selection will dominate. And second, there are papers on information transmission in OTC market. The distinction of our approach is to specifically and explicitly model the process through which information transmit through trading. And the advantage of this approach is to allow us to provide empirical guidance on how to find the evidence for information chasing. And this is actually a field in OTC market. This is actually a field that is lacking. There are not many papers yet about the effect of adverse selection or the reverse effect in OTC market. So this is I think this is a good place to pause if there are any questions.
Yes, there is one question from Mario Zoikin, and he's asking a question about the example that you showed on one of the early slides. He's saying, is it optimal for 2 sigma to always request two-sided quotes to incentivize such dealer behavior? For one-sided quote, the direction of the quote already contains the information.
Oh, that's a very good question. So the answer in our model is yes. It's always optimal for 2 sigma to request a two-way quote. And this is called request for market in the industry. And traditionally, in traditional OTC market, where people place phone calls, it is not necessary to request a two-way quote. So people typically do request for quote where they reveal their trade direction upfront. And there are articles recently about electronic trading platforms such as TradeWeb. On these trading platforms, you can broadcast your request to multiple dealers at the same time. And in the swaps market, it's mandatory for you to do that to at least 3 dealers. So there's this information leakage problem. So you don't want to reveal your information ex ante upfront to too many dealers. And therefore, it is getting more popular for traders, especially informed traders, to use request for market where they request two-way quotes on these multi-dealer platforms. Especially for large trades. So this is a trend in recent years.
All right, and we have another question. This one is from Pete Kyle. If the dealer can observe whether a trader is informed, should they not infer that a non-informed dealer is a noise trader and offer a tighter spread?
Well, that's exactly what we want to show. We are going to have noise traders in the sense that they want to buy or sell for liquidity reasons. In the benchmark model, it is not the case that the noise traders will get narrower bid-ask spread. I'm going to show you exactly why. So the short answer is that actually the adverse selection cost, so 2 sigma has some private information, so there is some adverse selection cost in the market. And this adverse selection cost, it turns out, is not borne by 2 sigma. It's passed through liquidity traders, through this information chasing channel. So as a consequence, 2 sigma actually gets a much better price than the liquidity traders. So I'm going to show you that as a result of our benchmark model.
All right, I think we have time for one more question. So let's go chronologically. This one is from Marcus Carrera, who is asking, in a multi-dealer platform, is being the second best liquidity trader the best position? Informed enough to be able to move prices, but not as dominant to have a significant inventory risk?
That's a very good question. So we are actually talking to some traders who use TradeWeb. It seems that the dealer who posts the second best offer, but lose the bidding war, can observe, can get notified that he is the best second best. So apparently he's getting more information than the other losing dealers. Now the question, this is not in our model, whether the dealers have incentive to be exactly the second best trading, offering the second best bid. In our model, if you lose the bidding war, even if you get notified that you're the second best, it doesn't matter. You don't learn the trade direction of 2 sigma. You don't learn anything about the value of the information. Here, the uncertainty comes from the value of the information, and we're going to have a binary state. Either the asset is good or bad. And this basically is revealed through the trade direction of 2 sigma. If you don't observe that trade direction, you don't learn anything. Even the second best didn't learn anything in the model.
All right, thank you so much, Chaojun. Let's go back to the presentation. There will be another stop for questions in about 10, 15 minutes, so please keep them coming.
Yeah, so in this 10, 15 minutes, I'm gonna first present the benchmark model where we have one asset, value is +1 - 1 with equal probability. Now, this is the slide that will summarize everything for the benchmark model. Now, there are three stages and 3 types of agents, one speculator, and dealers, and the mass of liquidity traders. Now, in stage 0, the speculator is going to pay some cost to acquire information. He can choose a precision eta and pay a corresponding cost of C eta. He will get a signal S. Now, the signal has a precision of eta. What does that mean? It means that the signal returns the true value with probability eta. And this eta can be between 0 and 1. The higher the eta, the more informed this precision is. Now, after the speculator acquires the information, if the signal is good, very naturally he wants to buy. If the signal is bad, very naturally he wants to sell. But he will submit request for market, as I said, to request a two-way quote from the end dealer simultaneously. He's going to receive an ask and a bid from each of the end dealers. And he's going to pick the best one. Now, it turns out in this picture, he wants to trade with dealer 2. So he is going to either execute the trade at the ask price if he wants to buy, or the bid price if he wants to sell. This trade is not observable to the other dealers in the market because this is, again, an OTC trade. Even if it's executed on the multi-dealer platform, the other dealers, they don't learn the trade direction. We can assume that they learn which position they were in the bidding wall, but that information is not useful in this model. Now, in the second stage, the liquidity traders is going to approach the dealers, and each of them is going to request either a buy or sell order. Now, it doesn't matter whether the request for quote or request for market, because their trade does not include any information. We just know that half of them wants to buy, half of them wants to sell. Now, let's say that liquidity trader number 1 wants to buy, so he's going to request an ask price from all of the dealers and pick the best price. So the second stage is pretty simple. So in terms of utility payoff, the speculator wants to maximize its utility over 2 variables, eta, the signal, the precision of the signal, and Q, the quantity of the trade. Oh, by the way, I forgot to say that when the speculator submits a request for market, he needs to say upfront how much he wants to trade. This is a necessary ingredient in the model and also in practice. So the dealers is going to quote prices according to the price. So they're going to give you a different price for a different quantity. So these are the 2 variables that speculator wants to optimize over. Q is observable to the dealers. The eta, precision of the signal, is not observable. It's a costly information acquisition that's only observable to the speculator itself. And in terms of utility function, well, he's going to first pick the best price, and then he's going to incur the information acquisition cost, and he gets the payoff from getting the asset. The expected value of the asset turns out to be eta, because we have a binary model here, so it's very simple. And he wants to maximize the total profit from the trade net of the information acquisition cost. In the second stage, we have a very simple first price auction, except that we have asymmetric information. Why? Because one of the dealers here, dealer 2, is going to have superior information than the other uninformed dealers. So we have a first price auction with asymmetric information, and we're going to show you the equilibrium in the next slide. Now, going back to stage 1, all the dealers are equally uninformed. So we have basically a Bertrand competition. They all know that if they can execute the trade, they will, in addition to the trade profit, or loss, they will get this information rent in the second stage. So having this in mind, they know how much the information is valued, and they're going to compete à la Bertrand. Okay, so this is the equilibrium bidding strategies of the dealers in the second stage. So we're going to resolve the equilibrium in backward direction. And the solution concept is perfect Bayesian with forward induction. I'm going to show you exactly where forward induction comes in. So in the second stage, actually, both the informed dealer and the uninformed dealer, they are going to use mixed strategies. Now let's start with the uninformed dealer. He's going to use a mixed strategy in the sense that he's going to post the ask price, eta. So this line is actually, this huge bar is eta. This is the fair expected value of the asset if the trader wants to buy. He's going to post an ask price of eta, and he's going to mix between 0 and eta with some probability distribution that we specify in the paper. And his bid strategy is symmetric bidding function. Now for the informed dealer, there are two cases. Either the informed dealer received a buy order from the speculator, and then he infers that the asset is more likely to be good, or he received a sell order from the speculator. Now let's just consider the buy case. Now the informed dealer learns that the asset is more likely to be good. So when he posts his ask price for selling, he's going to post basically the fair price, eta, with probability 1. And when he posts the bid price, he's going to mix between 0 and minus eta. Now here, the uninformed dealer wants to mix because they are facing a winner's curse, which means that when they get to execute the trade, they do sometimes in equilibrium, but when they do so, it's more likely the asset is bad. So in order to avoid adverse selection, more specifically to avoid being left completely with undesired trading orders from the liquidity traders, they are going to use mixed bidding strategies. And the informed dealer is going to respond by also using mixing strategies in order to avoid being completely outbid by the uninformed dealers. And this is the only equilibrium. There's no pure strategy equilibrium. Now, as a consequence, what happens is that the liquidity traders, they face basically random positive price bid-ask spread. There is a very, this price dispersion very naturally arises from winner's curse. And this price dispersion actually persists. By the way, we don't have any other friction. We don't have inventory cost. The only friction is information friction. So this price dispersion arises purely from information friction, from winner's curse more specifically, which is basically a new source of price dispersion in the OTC market that we identify. And this form of price dispersion persists even when the number of competing dealers goes to infinity, or when the signal's precision becomes perfect. The price dispersion is not going to go away. Now, this is the only slide that will contain some math where we describe the stage 1 bidding functions of the dealers. Again, in stage 1, the dealers are going to bid for the speculator. They anticipate that there's going to be some information gain if they can execute the trade in stage 1. So they're going to basically chase the informed order using Bertrand competition. The bid-ask spread, the mid-to-bid spread is going to be written as the following expression. There are two components. The first component is simply the adverse selection component. They need to cover the adverse selection cost. So if we just look at the first red component without the second component, this is basically the Gloston-Milgram spread. We can stop here if we don't have the second stage. Now, with the second stage, there is some incentive for the dealers to compete for the trade and chase for the informed order. This is what we call the information chasing component. Now, this information chasing component is also increasing in eta, the precision of the signal, because the more precise the signal is, the more incentive the dealers have to chase that order. And we can see that these two components, the second component serves as a rebate to the speculator, shrinking the mid-to-bid spread. The first component will increase the mid-to-bid spread. But both components are increasing in the signal's precision. So when you say that when eta increases, the precision of the signal increases in the sense that the trader is more likely to be informed, it is not clear whether the mid-to-bid spread will increase or decrease. It depends on the relative size of these two components. And we're going to show you when one dominates the other. Now, eta hat, what is eta hat? Eta hat is actually the dealer's inference about how precise the signal is, because the dealers don't observe the information acquisition decision of the speculator. They only observe the trading quantity Q. Very naturally, when they observe a larger Q, in the sense that the trader wants to trade a larger quantity, they're going to infer that the asset is more likely to be good. So they're going to increase their inference eta. So this is how it works. Given any Q, there's actually a dominant choice of eta for the speculator, which maximizes his payoff. It turns out that this is very simple, simply C prime, which is the information, marginal information acquisition cost, inverse applied to Q. So whenever you see a quantity Q, you're going to infer with forward induction that the information precision must be C prime minus 1 of Q. And it's also a dominant strategy for the speculator to choose that one. So we simply plug in that belief into the payoff function of the speculator, maximizing now over eta. It turns out that the choice of eta, equilibrium choice of eta star and Q star is going to be given by these numbers. Now, the more interesting result is that when we plug in back into the beta-ask spread, here we show that the beta-ask spread is going to be 0, meaning that the adverse selection component exactly offsets the information chasing component. So in equilibrium, these two forces offset exactly each other. Now, what happens to the liquidity traders? Now, through information chasing, the dealers basically transforms the adverse selection into winner's curse from in the second stage. So the speculator that gets a 0 bid-ask spread, despite them being informed. So they don't bear any cost of adverse selection. Who bears the adverse selection cost? The liquidity traders bears entirely the adverse selection cost, because now they face a positive bid-ask spread and even a random bid-ask spread with price dispersion. And with more liquidity traders, what happens to price discovery? Price discovery is going to improve because when M increases, there is going to be more incentive for the speculator to acquire information, so that his order is going to be more informative and price discovery is going to improve. And price dispersion also increases as a result of more severe winner's curse. So the price dispersion is not going to go away even with infinite number of liquidity traders. So this is the benchmark model. Now, next, I'm going to show you why we get this result of 0 spread. I'm going to do this in a more general framework. Now, in this more general framework, we do 3 things. First, we want to relax this assumption multi-dealer platform. In traditional OTC markets, there is no direct price competition. There is bargaining, there's some surplus split. So we're going to show that the winner dealer in stage 2's payoff, we're going to generalize it. In the multi-dealer platform, it's a half of MV. Let's generalize it to some function of V. And in stage 1, the dealer is not going to rebate 100% of that information rent to the speculator. He can rebate a fraction of that to the speculator. So VS is less than VI. Now, what happens in equilibrium? Now, still we have this convex function C for information acquisition, and we have this information rent for the speculator, V of S. Now, it turns out that the equilibrium choice of the precision is going to be such that the exposed value of the asset is where the two functions have the same slope. So we look basically for the place where the difference between the two functions is maximum, and this is where they have the same slope. Why is that? Does that have to be true? Because the speculator simply maximizes his value of information minus the cost of information acquisition cost. So he maximizes the gap between the two, and he finds the place where the gap is maximized. So, and it turns out that the slope is exactly the quantity that the trader would want to submit the speculator. Once we have the slope, now we can decompose the mid to bid spread into 2 components. The first component is adverse selection. This is simply V, the expected value of the asset. And the second component is an information chasing component, which is in the form of a rebate. So we go from this tangent point and we look at where it crosses the 0 line. So this component, this piece is the information chasing component. So the actual equilibrium mid to bid spread is going to be less than the Glosser-Milgram spread. Now, what happens when you have a more informed trader? So that this information acquisition cost C goes down. Now, what happens is that the equilibrium choice of information precision is going to go to the right. The signal is going to get more precise very naturally because the trader becomes more easily acquire information, can more easily acquire information. And the mid to bid spread also goes to the right in this case, meaning that the dealers is going to charge a wider bid-ask spread. Now, again, both adverse selection component and the information chasing component increases, but one adverse selection component goes up faster. So this is the case when we have a convex function of V. In the previous case, we have a linear function V in the benchmark model with multi-dealer platform. So when V is convex, adverse selection dominates. Now, on the other hand, when V is concave, I'm going to go through this much quickly. You can see that actually the information chasing component dominates adverse selection. So when the trader becomes more informed, the bid-ask spread is going to shrink relative to when the trader is less informed. In this sense, a more informed trader is going to get better pricing, not worse pricing. So here's the result. When V, the function V is convex, a more informed trader tends to get worse pricing and also to trade larger size. So this is the classic adverse selection story, the conventional wisdom. However, when V is concave, a more informed this pattern is reversed, completely reversed. A more informed trader tends to get better pricing and to trade smaller size. How much time do I have, Andrew?
I would say 8, 10 more minutes.
Okay, great. This is perfect. Now, in this case, I emphasize the word trader, meaning that this is a comparison across different traders, not across different trade within the same trader. Now, I want to emphasize this difference. Why? Because when we do within trader comparison, we can also do that in this framework. What we do is that we fix a speculator who receives a continuous signal S, and he's going to submit a request for market with some size Q of S, contingent on the signal he gets. So here the difference is that there is not going to be this dominant strategy of choice of eta. So we basically lose forward induction. And we are interested in separating equilibrium. We are interested in separating equilibrium because this is how we can make meaningful predictions about whether a more informed trade can get better price. Here we have a result. Now, a separating equilibrium exists if and only if the function V is strictly convex. When it's concave, there is no separating equilibrium. Now, why this result contrasts with the previous slide? This is because, as I said, when we have within the same trader who receive different signal, so sometimes the speculator is very optimistic about the asset. Sometimes he's mildly optimistic. Now, this is not observable to the dealer. And they have incentive, the speculator would have incentive to mimic each other. The low type, the one who receives mildly good signal, may have incentive to mimic the type who received a higher signal, and vice versa. So in order to have a separating equilibrium, there needs to be some incentive compatibility condition, which we did not need in the previous case. In the previous case, we simply applied dominant strategy for the speculator, and there's forward induction. That's done. So here there's an additional information incentive compatibility condition, which will basically put more structure, put more conditions on the existence of a separating equilibrium. So it only exists when VS is convex. So as a result, when you control for the trader, for the speculator, adverse selection always dominates. A more informed trader always tends to be bigger and also get worse pricing. So there's a very important distinction between whether you make a comparison within the same trader, controlling for the trader's identity, or across different traders. Now, most of the empirical work, they don't control for the trader for the obvious reason, because there is no identity for the trader in the data set. Nowadays, there are more regulatory data set that allows you to see the trader's identity. Actually, we are doing some empirical work to look for evidence of information chasing. And this is in progress. Now, as I mentioned, the Kyle model, the 1985 model, we can view this in this general framework. We can view this as a special case. Now, let's just look at the canonical version, where the value of the asset is Gaussian 0,1. The informed trader learns the true value, submits a market order as a function of the signal or as the value of the value. Noise traders submit noisy demand function, Gaussian 0,1, competitive market maker. And there is going to be some gains from trade between the speculator and the dealer, and the gains from trade comes from the noise traders. And and because the market makers are competitive, so they basically give all the surplus to the informed trader. And we can solve for the surplus, and it turns out to be a quadratic function, b squared over 2. And this confirms, this is consistent with this result, because in the Colliard model, there is a separated equilibrium, which is linear. And it exists because this function v is convex. And as a result, adverse selection always dominates. The more informed trade always get larger, is always larger and always get worse prices. Okay, I'm going to pause for questions.
Perfect. Thank you, Chaojun. We have quite a few questions, but the most popular one is from, or two actually, is from Liang Yang. And he's asking about the sequence in which these traders arrive. So he's saying, in your setting, the speculator always moves first, then liquidity traders, but what about liquidity traders first? In other words, what if the dealer doesn't know if the first client is a speculator or liquidity trader?
Yeah, that's a good question. So first of all, it is important that we do this in the OTC market, because the dealer needs to observe the identity of the trader before he responds with a quote. So in an exchange market, this is not going to work. And second, no, in the OTC market, you're going to see speculators coming, liquidity traders coming. So we don't have a dynamic model. We would love to, but as of this stage, having a dynamic model doesn't seem to add additional insight. Now, simply in this two-stage game, if you flip the order, it's not going to be interesting. But you can imagine that, when you receive a liquidity trade first, you just bid, but there is still going to be winner's curse, because from prior trading history, the dealers already acquired different information by trading with the speculator. So there, you can view this, the trade you can always view the trade against liquidity traders as a second stage to some more larger game or trading game over time. If this answers the question.
All right, thank you. And then the second question from Lian is about the client being able to change identity and trade twice, the speculator becoming one of the liquidity traders or vice versa.
Yeah, this is a very good question. So we are going to show you an extension model that this is not incentive compatible for the speculator to do that. Now, what we are going to do is that we're going to show that when there are two speculators submitting requests for market at the same time to the same set of dealers, in this extension model, we are going to show that the two speculators in equilibrium, they will always trade with the same dealer. Now, to be clear, the dealers in equilibrium, they are going to give the same quote to the speculator, to both speculators. However, they are going to the two speculators under some mild condition. They are going to coordinate and trade. By the way, there is no active coordination going on in the game. But in equilibrium, it can only be the case that both speculators trade with the same dealer. So this order splitting or duplicated trade is not going to work. In this simple benchmark model, if the speculator trades again on the same information, while the dealers over time is going to observe it, so in a repeated game, you can rule that out by reputation arguments.
Great. Okay, our next question is from Michael Goldstein, but I'm looking at the clock and I'm thinking that we may need to wrap up and move on to the discussion. Michael, given that your question is about the literature, do you mind voicing it during the live Q&A? Maybe it's actually a better way to address it. So let's move on. Let's move back to the paper and then the discussion. Then.
Okay, I will go through the extension very quickly. When we have two speculators, we change the information structure a little bit. We assume that the two speculators, they have signals that are correlated with some coefficient eta. They each have some precision eta, which is the correlation between the signal and the true value. And between the two signals, there is some correlation. Now, as I said, in equilibrium, the speculator, they're going to trading away, either trade with the same dealer or trade with different dealers. They're going to do that to maximize the dealer's aggregate stage 2 payoff. Why? Because they want to incentivize the dealers to chase their orders at the first place. So they're going to do trading away in equilibrium to maximize their aggregate payoff in the second stage. Now, this aggregate payoff is going to be very low when the correlation between the signals is very high. Why? Because the two speculators, they have almost the same signal. So if they trade with different speculators, there's going to be very high competition across the two dealers in the second stage, very low profit, almost like in the extreme case, when the two signals are identical, there's perfect competition in the second stage across the dealers. So there is no information right to be earned. So there is not going to be any information chasing incentive in the first stage. So when rho is high, it's better for the speculators to trade with the same dealer in equilibrium, and that's the only equilibrium that can be sustained. So let's look at what happens when rho changes. The rho, again, is the correlation between the two signals. When rho increases, the information rent is going to be higher when they are concentrated. And actually, when rho is higher than 0.17, it's better for them to be concentrated. Now, the two signals will be naturally correlated when both signals are mildly precise. So when eta, the precision of both signals, is more than 58%, the correlation is going to be higher than 17%. So this is a very mild condition. Why? It means that your signal just has to return the true value with 58% of chance. The benchmark, when you are 50, it's completely uninformed. So as long as your information is mildly precise, there's going to be information concentration. So on a multi-dealer platform, information chasing is a natural monopoly. A larger dealer emerges from ex-ante identical dealers. Despite direct price competition, actually, it may further increase the market power of large dealers as a countervailing effect. And we don't have a dynamic model, but if you do have one, you can imagine that the endogenous market power of an informed dealer can get reinforced over time. So to conclude, we offer a theory that trades off two countervailing effects, information chasing against adverse selection. We show that on a multi-dealer platform, these two completely offset each other. More generally, a more informed speculator can receive tighter bid-ask spread in the sense that information chasing dominates adverse selection. We offer empirical guidance on where to find such evidence. It has to be across different traders, not within the same trader. And as an extension, we show that on a multi-dealer platform, an information monopolist arises as a result of information chasing.
Thank you very much, Chaojun. The discussant is Jean-Edouard Colliard from HEC Paris. Jean-Edouard, if you want to start sharing your slides, unmuting yourself, and things like that, perfect.
Yep. Hello, does that work?
Yes.
Okay. Hello, everyone. Thanks a lot for allowing me to discuss this this paper. So I really enjoyed it, and it's a great pleasure to to see, if only the names of all the participants and to to know our community a little bit. Okay, so so this is a very nice theory paper. Let me remind you very quickly, what this is about. So the point is really that OTC markets are not anonymous, so you know whether a trader is likely to be informed or not. Traditionally informed traders are a source of adverse selection. You want to quote wider bid-ask spreads. At the same time, if you trade with an informed trader, this is going to give you some information, and this can be valuable in the future. So hence the idea that you may want to quote tighter spreads to informed traders in order to attract their orders. So this is called the order chasing effect in the paper. And this can explain why actually more sophisticated traders can get better prices. And this is particular to OTC markets because this all relies on the fact that informed traders, are known to the dealers posting the quotes. So you know that you might want to attract a particular trader. Okay, so that's basically the idea here. So just, I thought the presentation was very clear. So if you want to have really, a toy model that really makes this point, this can be made very simply, I think, which shows that, it's quite a fundamental feature, I think, of OTC markets. So imagine you have an informed trader. He knows whether the value is -1 or 1. You have two dealers who quote an ask and a bid, and the informed trader is going to trade at the best quote. Okay, and the key thing is that the transaction, the direction of the transaction is privately observed only by the winning dealer. Okay, so if you have the best quotes, you are going to learn whether V is equal to -1 or 1, and the other dealer doesn't know that. Okay, then in stage 2, you have uninformed traders who arrive, and the two dealers are going to quote for one unit. Okay, so one of these dealers is going to have more information than the other one. Okay, so that would be like the most stripped down version of the model I can think of. Then you can think about how this is going to be solved by backward induction. In stage 2, you have these two dealers who are competing to attract the orders from the uninformed traders. Okay, and obviously the dealer who has information is in a better position because he's going to avoid the winner's curse. Okay, so Chaojun explained this very, very well at the beginning of his presentation. So what you are going to get here is simply that the informed is going to get a higher profit than the uninformed dealer. Actually, you can, in this super simple example, you can see directly that the informed is going to get 1/2 and the uninformed trader is going to get 0. Okay, so that's the second stage. Then you move back to stage 1. So in stage 1, you have to to choose your quote for the informed trader, anticipating that if you win this first stage, then you are going to get 1/2 in the future instead of 0. Okay, so you do that. You say, well, if I'm the one selling the asset, I get at a price A, I'm going to get A minus 1 plus pi I. Okay, so A minus 1 is basically due to adverse selection. You know you are going to sell the asset when the asset is valuable, but you are going to get this pi I equal to 1/2 in the future instead of pi n. So in the end, you can solve for the equilibrium spread. It's equal to 1, so that's adverse selection. Okay, so we have -1 and 1, so this is just adverse selection. And this pi I minus pi n, which is equal to 1/2, this is the order chasing component. Okay, so very, very stripped down version of the model, but basically the model is very clear. It makes this point very, very well in a more general framework. Okay. All right. So very nice model. I thought the economics were very, very clear. The results illustrate very well how the usual intuitions about adverse selection can break down in OTC markets. I thought it was super interesting to read, but I know the big picture could be a little bit clarified, and so that's basically what I'm going to discuss. Okay. So again, the theoretical insight is very clear. But the fact that trading with an informed party is valuable, this is not completely new. I mean, this is done in a very, very nice framework where it's very clear and very transparent. But in a sense, if you read Glosson and Milgram with the dynamic version, you already get this idea that actually you are exposed to adverse selection at the beginning, but that's going to make you learn more quickly. And this is exploited actually in this paper by Glosson and Putnin's thinking a little bit about these dynamic effects. Okay, the idea also shows up in other papers like Lyon, Zhou, and so on. So again, all these are different things, and this is not to belittle the contribution of the paper, but I think the idea was a little bit out there. So is the point of the paper that it just really makes this idea very, very clear in a more canonical setup, or can we derive other results? So I would like the paper to actually go a little bit further than just giving this theoretical insight, and I think that's why it's important that we have these additional sections at the end. Okay, so I think we would need either the paper to show that you can really explain important stylized facts, or that we can derive interesting economic implications based on this idea. So the paper does the second thing a little bit, and for the third thing, I think we could do a little bit more, perhaps. Okay, so let me discuss that. So stylized facts. Okay, so the motivation was that more sophisticated traders obtain better prices. Can we go a little bit beyond that? So can we, for instance, estimate this order chasing component in the data? Is it related to the decomposition of the spread in the same empirical paper? Maybe can the paper explain why larger orders tend to get better prices in general? Is this like a new a new explanation for this phenomenon, which is well known? Are there unique predictions that come from this mechanism? All this could be explored a little bit more. I also thought that there were interesting connections to make with other empirical papers like Kondor and Pinter, for instance, or Boyashenko, Luca and Velkamp, and probably others. So I think all this could be the link with the empirical literature could all be exploited a little bit more. Okay, and again, it's a relatively preliminary version, so it's normal that not all this is done, but I think this is very promising for the future. The other part that I found very interesting, and Chaojun did not have too much time to talk about this, is the idea of market concentration. So the idea is that if you have a dealer who trades with the first informed trader, then he's in a better position to trade with the second one. And so you can imagine that you have many, many traders arriving after each other. And maybe actually the advantage of the informed dealer is only going to get bigger over time. So then it could be that, that basically there is a natural monopoly, that if you win the first auction, then you are going to win all other auctions in the future. And that could be interesting to explain, you know, why we tend to observe a very limited number of dealers on many markets, you know. So maybe there is a kind of informational natural monopoly. So I thought this was a very, very interesting idea. It was hard for me to understand the setup, honestly, because I thought I was lacking some of the details of the game. So for instance, if you don't win the auction in the first step, when you don't win the auction with the second speculator, it's actually a signal that you were outbid by the other guy, which by itself gives you information for the last stage. So this sounds extremely complicated because this should be taken into account by your competitor as well. So it's really a complicated game, and it solves very, very quickly in the paper. So I was not sure I was entirely following. The other issue is, well, the timing. You know, it's clear that it's key that we have an informed trader and then a liquidity trader, as somebody pointed out. I think it was Mao. And then the mechanism is also a bit particular because information protects me only from the winner's curse. It does not protect me from future informed traders because we assume that there are no informed traders in the future. So I was also wondering whether this is very general. I was thinking, you know, maybe if we want to make the very theoretical point that information is a natural monopoly in dealer markets, maybe it would be nice to do this in a more canonical model. So I think this would be, to me, the ideal canonical model to do that. And it's not very, very far from what the paper does. Imagine you have an infinite number of periods. In each period, you have an informed or a liquidity trader, but it's random. So for the moment, it's exactly like Gloston-Milgram. You have two dealers who compete with each other. Each dealer observes the type of the current trader and then posts prices. Okay, so it's really Gloston-Milgram, but just you assume that you can observe the type of the trader before posting your quote. And then the question in this model would be, does the dealer who trades with the first informed trader then win all other future auctions? Okay, and I think this would be, if the point that the model makes is very general, we should be able to see it in a canonical model like this. But again, I thought a little bit about this model, and I thought, wow, this is going to be actually incredibly complicated, even though this sounds like a very minor extension of Gloston-Milgram. Okay, so all these things are maybe could be explored a little bit in the future. So this is an apologetic slide because, you know, if the model has 1 or 2 periods, we ask the authors to have n period models, and if the model has n periods, we ask the author to have only 1 or 2 periods because it's clearer. But, okay. Another issue, so market design. So here we have this RFM mechanism. Is it better than RFQ or than an anonymous design for total welfare, for dealers, for informed traders, for uninformed traders? So all these are things that the paper could discuss. I'm not saying you necessarily should, but maybe this would be something interesting to report as well. And also maybe more fundamentally, so is this a paper about really OTC trading, or is this rather a paper about anonymity and transparency? Maybe it's a little bit, because the point is really that because it's OTC, then you know the identity. But even in centralized markets, you could know the identity either pre-trade, post-trade, depending. So I don't know, maybe it would be worth connecting also to this broader literature, because I think it may be a little bit broader than just OTC markets. Okay. Right, so that's one short comment I had. So in the case with heterogeneously informed traders, something I found interesting is that, well, if you quote a very narrow spread, then actually even traders with very little information are going to trade with you. So you are going to get the signal very often, but it's not a very informative signal. Whereas if you quote a very wide spread, you are going to trade less often, but the signal is going to be much more informative because only very informed traders are going to trade with you. So I was thinking, you know, if you are a monopolist, probably you don't want your spread to be too narrow. Probably you learn more by quoting some interior bid-ask spread. And maybe that's not possible with competition. So I was also thinking about, you know, having a monopolist dealer versus 2 dealers. Again, I don't know if that's necessarily what you want to do in the model, but I think this is something interesting potentially to do. I have some theoretical nitpicking, but I will send you the slides. You know, it's not very interesting for the audience. One thing maybe I thought that having this endogenous Q and eta in the baseline model with homogeneous traders, I thought this was, you know, complicating things a lot for not too much additional insights. So I would have done things a little bit differently. Okay, but that's really a minor point. Okay, so let me conclude. So very interesting model. I thought there was a lot of food for thought, a lot of ideas to analyze further. I don't know, I feel that you still can find, a better punchline by going a little bit more in one direction or the other. So it seemed to me that, the one-line summary of the paper was still not completely final, probably. So that's why I tried to give, some possible suggestions. Perhaps there are several papers to write about this, actually. So that's quite interesting. Okay. So I really enjoyed it. So I recommend everybody to read the paper, and good luck with this paper. Thank you.
Thank you very much, Jean-Edouard. Chaojun, we are letting folks ask questions first, and then you respond to Jean-Edouard if there is time. So the raise hand function has been enabled. You guys are welcome to raise your hands. I've preemptively unmuted Michael Goldstein. Michael, if you still would like to ask the question about the literature that you put in the Q&A box, please go ahead.
Sure, but I'll do it quickly. So I just wanted to point out there's some papers in the early 90s. Leach and Madhavan had a couple which talked about price experimentation and talked about different kinds of markets and market structure. And there's a very fascinating paper by Ben Vinci-Wilhelm and Marcus on what's so special about the specialists that talked about the ability to differentiate who's coming in. That might help with some of the, at least put in some context what the discussant was talking about. And I think ultimately the big question is it's, kind of who moves first and what information does one have. So that, but it's not worth taking up everyone else's time.
So yeah, very quickly, we are aware of these papers by Leach and Haven, feminist. So these papers are, you don't have to trade to get the information. You can, the specialist on the upfront floor, they can just approach the traders to somehow get the information. So the information transmission mechanism is kind of reduced form in those papers. So the approach that we are taking is that you have to actually chase to trade with those traders in order to get information, and there is price implication. And ultimately what it allow us to do is to tell exactly where to find evidence for information chasing.
So I don't have any raised hands yet, which I think allows me to read maybe, oh, well, I do now. Pete Kyle. Pete, please go ahead and unmute yourself.
Okay,
go ahead.
Can you hear me?
Yes.
Yeah, okay, I think I would like to recommend that you talk about what the assumptions are about the structure of the market as they map into actual kind of practices in dealer markets in the real world. Are there assumptions being made about tick size? I think the answer is no, but in the real world, it's very important. Are there assumptions being made about trade size? I think the answer is no, but in the real world, it's very important. Are there assumptions being made about who observes what and when and how quickly? I think this particular paper relates very strongly to the literature on price reporting and the policy debate on price reporting. What is it that's being learned from dealers reporting prices and quantities promptly versus what happens when you change the model and they don't have to report prices and quantities promptly. And then finally, you've got assumptions based on the ability of people to get together and do trades outside the dealer framework. So I would kind of try to map it all into the institutions and policy discussions that we're having. I'll stop there.
Thank you. These are all very good questions. So very quickly, yes, we don't have assumptions on the size of the trade that you can submit. We don't have assumptions on the tick size of the quote. Everything is continuous here, unbounded, and we abstract away from the institutional features of these assumptions. Now, for the price disclosure, yes, price reporting. So this is important. We do discuss that in the paper. So in the model, there is no price disclosure, trade disclosure. So when the first trade takes place, only Goldman, who execute the trade, knows that he executed the trade. The other dealers don't. Now, in practice, there is, even in OTC market, there is post-trade transparency. For example, in the corporate bond, you have trades where the dealers have to report the trades to FINRA. And then with some delay, I think that now it's being discussed that they're trying to make it longer, shorter, but with some delay, they're going to observe, the other dealers are going to observe what trade takes place at what price, etc. Now, what we predict is that these kind of price reporting regulations, they're going to diminish the incentive of the dealers to chase information at the first place. And in turn, that's going to diminish the speculators' incentive to acquire information. So overall, what we find is that these price disclosure rules, they will actually reduce the price efficiency over time. So this is a prediction of the model. And there was another question. Sorry, I don't remember. The last question was.
Chaojun, actually, I think Pete has a follow-up question.
Okay.
But before and maybe he'll remind you his second question then. Before we do this, we've crossed our hour mark, so I need to officially end the official portion of the seminar and thank Chaojun and Jean-Edouard for their presentation and discussion, respectively, and all of you for questions. Our next week's webinar is by Mina Lee, and the discussant will be Gideon Saar, and that's the last seminar of the Emerging Scholars Month, and also the last seminar of the summer because we're taking a couple of weeks break in mid to late August. So hopefully we'll see you all there. And now moving on to the unofficial portion. Pete, please go ahead.
Oh, can you still hear me? Can you still hear me?
Yes, I can. I
muted myself. Yeah, I think the price reporting issue is really an interesting issue, and that your paper probably does have a lot to say about it. And it seems like what you're saying is that it encourages information production, but that would mean that it makes the market less liquid. Later price reporting encourages information production, but makes the market less liquid.
So just want to clarify. So post-trade transparency, which requires the reporting of the trades, some delay, is going to reduce the incentive to produce information because there is less incentive for the dealers to acquire, to chase that information at the first place. So
yeah, right. So if we try to map this into a kind of a time horizon sort of thinking, the argument a dealer would make, which maps into your paper, I think, very well, is they would say, we do this trade with a trader, we don't want to report the price until we've had time to get out of the position. And exactly. That's essentially kind of what your model is about, right?
Yeah, exactly.
And so the dealers would say, if we have to report the trades extremely promptly, that is going to lower market liquidity. And
yeah, we didn't. Yeah, that's a good point. We didn't think in that dimension, but that's a very good point. Yeah. So you're saying that it could reduce.
It might be that it goes the other way. That's what I wanted you to just, if you couch it in that public policy discussion framework, you might be saying something different from what most dealers are actually saying.
Yeah, that's very useful. So you're saying that if there is prompt reporting requirement, then the dealers will have more pressure to offload their position. That would decrease the liquidity in the second stage. Yeah, that's a very good point.
Well, it might decrease information production, so it might increase liquidity. It's not clear which way it goes. So
exactly.
You need to. Anyway, I would make.
We need to think about it.
Very quickly. I'll let other people talk.
Yeah. We need to think about it. Thank you. That's a very good point.
All right. The next question is from Peter Lerner. Peter,
no, it was a mistake.
Oh, all right then. In that case, Joel, please go ahead after unmuting yourself.
Yeah, thank you, Andre. Can you hear me?
Yes.
Good. This is really a follow-up on Pete's point, which is that the argument for delaying trade reporting is always that it gives the dealer time to work off the position. The dealers would do this in an inter-dealer market, which at least to other dealers is a lot more transparent generally than the customer to dealer market. So in terms of who trade reporting, or I should say failure to report trades hurts, it is not so much other dealers, but it's ultimately the customers. And this you could see if your model were to incorporate an inter-dealer framework that would be somewhat transparent.
Thank you, Joel. We're going to take note of this comment. Thank you.
All right. And then we have Mina Lee.
Hello, can you hear me?
Yes.
Hi. Thanks for. Hi. Very nice paper. I was just curious about the strategy of the speculator. I was wondering whether he could kind of lower the number of shares that he asked for the quote. Like, let's say he wants to trade Q shares, but he requests for quotes for Q over N shares, and secretly planning on accepting N offers. And it seems like that's going to increase the information chasing component in this. But at the same time, it's gonna make the dealers to compete for the order flow from liquidity traders in the next stage. And so if the dealer is aware of this possibility, I don't know how the equilibrium will play out.
Yeah, thank you, Mina, for the question. So the secret, yes. So first of all, it's not going to be an equilibrium where the trader splits the order, the speculator splits the order in the way that you described. So let's say I have 2 dealers, I want to trade 10 units. It's not going to be an equilibrium for me to submit 5 units to one dealer and 5 units to the other dealer. Why? Because if I do that in equilibrium, then the dealers have 0 incentive to chase my order in the first place, because both of them are going to be informed in the second stage, no information rent. They're going to compete a la patron in the second stage for liquidity traders. There's no reason, no benefit for them to chase my order at the first place. So I'm going to get a very wide bid-ask, the Gloston-Milgram spread for both orders on the first stage. So it's not going to be an equilibrium in the model for you to do that. Now, the more interesting point that I think you are making is that kind of secret deviation can destroy the equilibrium that we're trying to sustain. That's a very good point. So in the current model, the answer is yes. If you do, so first of all, we don't allow that to happen. So on a multi-dealer platform, what we simply assume that you submit an order, you receive 2 quotes from 2 dealers, you trade with one of them. This is how the platform works. You can't trade twice with both dealers. Now, if you secretly submit the order, same order again to a different set of dealers in the next stage, over time, the dealers are going to, kind of infer that you're not really that, you're not, maybe they're going to say you're not that informed, or other you're kind of leaking information to other dealers. And we have talked to participants, and they do keep track of this. So over time, reputation, by reputation, you're going to have a very bad reputation to Sigma if they do that all the time. And they are going to be kicked out of the game. They are not going to be chased again. So there is a dynamic equilibrium in which they do things consistently to trade off the benefit of the incentive to split this order secretly versus the reputation damage that they're going to incur. We don't have a model for that.
All right, Chaojun, I don't have any more raised hands. Well, actually, I do have one. Oh, it's from Pete. Pete, I think you're still allowed to talk, so just please unmute yourself.
All right, now can you hear me?
Yes.
Yeah. Okay, so I just want to emphasize that Mina has made an interesting point about the institutional details with how, with respect to how the market works. Whether you can trade with multiple dealers at the same time, and think about what are the kind of public policy issues and regulatory issues that allow or prevent that, or is it an informal practice by the dealers? Is it a formal rule? Is it collusion? All of those are important points. And then Joel made another point that's also important about the way the markets are organized, that you have this, the way in practice, you typically have a pretty transparent intra-dealer market among the dealers that doesn't share price and quantity information promptly with the customers. And all of those kind of features of the real world map into your equilibrium somehow. And I couldn't download a copy of the papers. I don't know what you actually are showing in there, but they're interesting to discuss.
Yeah, thank you, Pete. Yes, so the paper is preliminary, so we are not posting it yet. We just posted an abstract on SSRN. And all these points are well taken. At the current draft, we don't have an interdealer market, so that issue has to be dealt with. And related to Mina's point, where how many dealers can you trade with at the same time, whether you can only trade with one or multiple dealers, the the way that we do it right now is that when you submit a quote, when you submit a request for market to, let's say, 3 dealers at the same time, you trade with one of them. You can't trade with 2 of them or 3 of them at the same time. And this is how the current, the mechanism, this is how it works in practice. On multi-dealer platforms, you get the 3 prices, you pick the best price. You have to pick, you can't trade 3 times. You can do that again to maybe a different set of 3 dealers. You could do that. That is allowed in the system, in the mechanism, but that would have to be disciplined by reputation concerns. If you do that over time, the dealers learn it. They are going to understand that it's not that valuable to chase your order. So you kind of kicked out of the game. So the second, yeah.
So if you change, I actually want to second the idea of discussing this literature from the 1990s. And at one point in the 1980s, I was thinking about this, and I was thinking about exactly the way you motivated it with your motivating example, you know, of a dealer undercutting and getting an information advantage. But I was connecting it in my mind at that point with price reporting. And I was planning on one of the, back then, writing a paper with Elsa Roel, but I think she had already started writing a paper, maybe with Marco Pagano, I can't remember what, but we wound up submitting a little comment on the proposal in London for price reporting. And a lot of I think there were several papers that came out of it, none really by me, other than the comment on the London thing, that are related, that kind of come at the issues that you're coming at from the perspective of price reporting. But the way my thinking went was, now that Mina's here, we can talk about, was that you would undercut the bid-ask spread and trade very small quantities dynamically. So I think you're kind of requiring people to just trade once, but suppose they can't. Suppose they can divide their trades in little pieces and trade gradually with many dealers, one right after another. If you allow that to happen, I think what happens is that markets become kind of what I would call a smooth trading equilibrium. And you get something, a market structure that looks kind of like what Mina and I propose in our little Oxford Economic Review paper that basically says that people will trade smoothly. Their inventories will be differentiable functions of time. And I think that structure might be pretty resilient, meaning if you have that operating, it might be rather difficult for traders without directly colluding to break that equilibrium. And that equilibrium is very, very customer friendly, and I think it might be the natural equilibrium in the market. And you're breaking it by assuming that traders cannot trade sort of many times by breaking the orders up into little pieces, but they have to kind of come in and announce, I'm going to trade once, here's the quantity.
So yeah, that's a good point. So we don't have, at this point, we don't have a model to break the equilibrium that you described. But what we imagine the way that it would work is that if you, let's say 10 units, break it into 2 pieces, 5 unit in the first round, the second round, another 5 unit. So in equilibrium, this is not going to be, if this is a choice variable for the trader for 2 sigma, he actually may not want to do that in our model. He will not want to do that in equilibrium, because if he does that in equilibrium, everybody anticipates that behavior by 2 sigma. So if the first dealer, Goldman gets the first 5 unit, JP Morgan gets the second 5 unit, they basically get the same information from both trade. They all know that whether the asset is good or bad. Then there is no subsequent gains for both of them, for either of them to be making. So it goes back to Gloster-Milgram, meaning that they're going to post the Gloster-Milgram spread to 2 sigma. So the payoff is going to be 0 for 2 sigma if he does that in equilibrium. So it's like, so there are 2 different issues. This is what we are showing, that this cannot be in equilibrium, but we can't show whether it's a profitable secret deviation. It would be a profitable secret deviation in the way that we have it right now. But if we have multiple stages of the same game going on, maybe we can kill that equilibrium, but we don't have a model for that.
So my summary of what you just said is that you allow the customer, the big customers, to commit to only trading once.
In the model, we don't. in the model,
Yeah.
Okay, just to be very clear, this is important. Whether we allow for, we have this commitment. We need this commitment. Okay, so if we allow the traders to do that, we could. It's not going to be this in our model. The smooth equilibrium, the order splitting equilibrium, is not going to be in equilibrium. So it's not going to be in equilibrium if we allow them to do that. It's not going to be equilibrium when they split the 10 units into 5, 5.
Can I just mention, like, because this was also your response to my earlier question. I just want to say one thing, that your argument for ruling out this equilibrium is only based on the pure strategy. What about mixed strategy on the part of a speculator? So speculator will never commit to splitting 100%, but it seems like there is a possibility of mixed strategy, and the argument may not go through for ruling out this equilibrium, no?
Yeah, I need to think.
Agree. Let me say, I agree with Mina, and furthermore, it might be that when you go through that logic, you end up with a no trade equilibrium, something like the market breaks down. You're ruling out an equilibrium. That doesn't mean that what you have left is an equilibrium.
Exactly. Yeah, that's what I was going to say. So basically, we could, if we do allow that order splitting choice, maybe we're going to rule in both equilibrium. Just to answer Mina's question, it's if you do a mixed strategy for the speculator, let's say with some probability, I'm going to submit my order to one dealer only. With some probability, I'm splitting. That I think can be, that middle point can be interpolated by the two extreme points. So if we show that the order splitting with 100% is not an equilibrium, maybe that middle point is not, but we need to work out the math. All these are good points. So about Pete's question, yes, if we do allow for that, maybe we're going to have a no trade theorem in the current model. I think that's a correct conjecture. Now, if we do want to sustain equilibrium, what we would need to do is a multiple state, I think. This is where I'm thinking right now. A multiple repeated game of the same game that we are having. So 2-stage again, tomorrow another 2-stage. And then allow the dealers to update the belief, to implement some punishment strategy. If in the first period, if the speculator 2 sigma did that, secretly deviated from order splitting, from concentrating his order and split his order into 2 pieces. In the second round, the dealer could punish it. It doesn't have to be active coordination or collusion. I think that kind of punishment would be sub-game perfect, but we need to work out the math. This is just my pure conjecture at this point.
All right. We have one more question from Michael Goldstein. Michael, if you're still here,
yes,
please go ahead.
Sorry, can you hear me? I'm not sure.
Yes.
So I thought so a couple quick comments. First, a great opportunity to listen to Pete and you guys talk about this is a wonderful. Couple quick comments about kind of what the discussion was saying about putting it in context. I'm sure it's in the paper, was not quite as clear, but there's some very specific assumptions about the style of market here again that the dealers can't see each other's quotes, and particularly about speed, if you think about it. This can't be too fast of a market. I'm going back to a couple weeks ago, 3 weeks ago, when we heard about the microsecond market in the ETFs. And it's like, there has to be enough time for somebody to go and basically ask for a 2-sided quote, come back, decide which one they want to go to and things like that. But then I was thinking a little bit more about this, and I suppose, and it's all just to help you put it in context. Again, if you go back to the 1990s, I guess we're showing our age, but if you go back to the 1990 literature, perhaps, payment for order flow or preferencing or something like that is a way that you could do with different knowledgeable people, where you could say, look, this is all going to move too fast, but what I'm going to do is I'm going to give you, because I know you're informed, a little rebate off of whatever I firm quote. Like, I guess since I have a paper on illiquid markets, I was thinking like, yeah, all this all works, but this market can't move too fast because you just can't do this fast enough. The market will move. The risk in this, getting the quotes and everything else going back and forth, is the market moves. And so you kind of need a not very fast moving market for this to work. And a faster moving market, there's probably some kind of repeated game, generalized discount I'm giving you to make it work. And that was, Battalio's work and other work in the 90s about preferencing and payment for order flow, perhaps. That's
Yeah,
it.
we haven't, yeah, thank you, Michael. We haven't thought about, this is a good point that you raised. We haven't thought about the relationship of how quickly things move in a market and how large of this information chasing incentive there is for the dealers when you think about that. What we do have, it's not on the speed, but it's rather on, in the model we can deal with that, the massive liquidity traders. So if you think about some more liquid markets like the treasury market, where you have a lot of liquidity traders who wants to buy treasuries for liquidity reasons, not on private information. There are also speculators who speculate on these markets on private information. So when the ratio of liquidity traders versus informed speculators goes up, in the sense that you have more and more speculators, you have more and more liquidity traders relatively, then we are going to show that the market there's going to be a stronger incentive for information chasing. Now, this is not the same as what you are saying, the speed, but it's kind of like a close approximation that we have can deal with that. So the liquidity of the asset, how much liquidity traders you would attract, would increase the information chasing incentive. We don't have the speed.
Yeah, I'm sorry, I don't know if I'm still on, but I was just kind of thinking that, the process that you described takes X amount of time. It's not a firm quote hitting process.
Yep.
And therefore, there's just a certain amount of, the risk there is time versus variance, right? If it's a very stable asset, it probably doesn't matter much. If it's a highly fast moving asset, this could be unduly risky for even the informed, like thinking about preferences of style of market structure. So there's some kind of trade-off. All I looked at is like, okay, there's some kind of trade-off here where there's a certain amount of weighting, if I was the dealer and I just trade with informed and I didn't want to trade with informed again, I could just increase my quotes and just wait till I get a liquidity trader. Like, there are ways to do this, but there is some risk of in the microsecond world, this I think would just be hard to pull off.
I would definitely agree with you that if we're in a microsecond regime, I don't see how, but in the OTC market, while this is the microsecond regime, high frequency trading firms, I think this is another interesting question to think about. High frequency trading firms, they only kind of like mostly predominantly intervene in the exchange market on the central limit order book. They can cancel their orders, submit their order. Eric Bodish has talked about that. On the OTC market, you have to request your quote first, get a quote back, respond. There's delay that basically preempt the high frequency trading firms from entering. There is, for the treasury market, there is an interdealer market where it operates with a central limit order book. And there, the high frequency firms, they do intervene heavily in the US treasury market. But that's in the interdealer market. No customers are going there. So we don't have data on that. There are some articles about it. But other than that, in most part of the OTC market, because you have to request a quote, because you have to have this delay, and the reason for one important reason for the price to move very quickly is actually gone, because the high frequency firms, they wouldn't go there to begin with. The prices usually, I would say, are not in the microseconds for OTC trading.
Sure. In fact, you could imagine some other paper that talks about if there were two markets that existed simultaneously, it would seem to me that the adverse selection, the speed of which things move, if you were an informed trader that had a choice of two different markets here, it would really depend on the speed of movement. You might get a slightly better price in an OTC market, but if it takes too long, you might not want it. So that's a very other future research kind of thought, but just kind of there is a time that you're exactly right. These kind of markets by necessity are somewhat slow. That actually is built into the structure of what you described, and that has some market design aspect to it.
Yeah, I agree. So on your point where you have two market values, one central limit order book and the OTC market you can choose from. I do have another paper with another co-author on the choice of between these two choices. We don't have the speed, and the story there is a reverse selection. And if we map that into our current model, so let's imagine the model that we presented today. You just put another central limit order book in parallel. Now, what's going to happen, what we think, is that the central limit order book, the price is going to be moving faster there, more efficient. It's going to incorporate information much faster. What's going to happen is that in the OTC market, there is going to be very limited incentive for the dealers to chase those informed orders, because they can just look at the central limit order book and see what price is there. And I think we have the exact same intuition as you do have. If there is a parallel market where prices move very fast, there wouldn't be incentive for the dealers to acquire information in the OTC market, because doing that, your information becomes stale very quickly, and everyone else learns the information more quickly in the exchange market. So I think one requirement for us is that we can only look at markets where you only have an OTC market, or you can have a very small exchange market where the prices there are only good for the small trades. I think a lot of the OTC market has this structure. There are recently some electronic trading platforms where they implement central limit order books. Swaps market, for example, they have to have a central limit order book in parallel with these requests for quote trading protocols. The volume is very small and the quantity is very small. You can only trade a small quantity there. It's not a requirement, it's by choice, because if you do, there's not much liquidity basically in the central limit order books. It's kind of empty. Only the dealers use that, customers don't use that, and somehow people are not using it. That's the point that we kind of raised in the other paper. When you have a choice, when do you go to one versus the other? In what kind of scenario would the central limit order book be virtually empty? But in this paper, we would have to kind of assume that, and assume a very small or limited exchange price discovery process, and then focus on the OTC market. But it's a good point.
Folks, I think Pete has a question, but before that, I wanted to tell you that we're going to have to switch captains here. Andreas is going to be in the cockpit because I have another meeting at 12:30. Pete, go ahead, please.
Thank you, Andre.
Pete, if you're still there, you're on.
Yeah, I have muted myself. Can you hear me now?
Yes.
Yeah, okay, I'm sorry. High frequency traders have information that has a very short horizon. And so one of the features that might be important to add to these types of models is the horizon over which the information decays. Because if you're a dealer, you want to trade with someone whose information decays very slowly because it gives you time to much more time to get out of it. But another point that's related to this high frequency traders is that when you trade with a high frequency trader, you don't really know you're trading with a high frequency trader. And dealer markets have a kind of lack of anonymity where you kind of know that you're trading with a dealer. In a all-to-all platform with high-frequency traders participating, you kind of never know whether you're trading with a high-frequency trader or not. So the dealer function, to the extent it's performed by high-frequency traders, is performed anonymously. This was one of Fisher Black's critiques of my 85 paper. So, you know, one of the hidden assumptions, if you will, of my 85 paper is that you can keep track of the dealer inventories simply by watching the price changes, because you know that the dealers are always buying at the bid and selling at the offer. But in all platforms, it really doesn't operate that way. And high frequency traders are sometimes buying at the bid, sometimes selling at the bid.
Yeah, that's very closely related to the point that we are making, that you have to, for the evidence of information chasing, for this to work, basically, the comparison has to be made across different traders. So you have to be able to tell which trader is informed, which trader is uninformed. Now, by the way, there is still going to be a separating equilibrium. Oh, thank you, Jean-Edouard, for the discussion. I'm going to email you later. So there is a separate, there is going to be a separating equilibrium if our VS function is convex. So how this is done basically is that when the VS function is convex, or the gains from trade is convex, so even if I cannot tell who is whom, when I see the quantity, I can kind of infer the precision of this, the information value of the asset coming from the trader. Very naturally, a larger quantity is associated with a more informed order. So even if it's a completely anonymous, I can tell sometimes which order is more informed. However, they will not have incentive to chase that more informed order. And reversely, they are going to be scared away by adverse selection. This is because, to begin with, to support this separating equilibrium, we have to have this convex BFP function. And under this convex regime, adverse selection always dominates order chasing. So the problem is not really whether you can tell, observe, or infer. Sometimes you can infer the informative distributed order, but when you can infer, you would not want to chase it. You would be scared away from that order. So this is the reason why what we predicted that in this completely anonymous market, where you do have prices, the quantity discrimination. So for a different quantity, you're going to have a different price. So you have the central limit order book with different depth. Each price will be associated with a certain quantity. You can motivate that multi-layer central limit order book by saying that if you want to trade a larger quantity, it's more likely to be informed. So I'm going to give you a wider bid-ask spread. Now, this is, we say that this is only, you can only do that. So this is consistent with the fact that in these kind of markets, even if there is a separate equilibrium, it's only consistent with adverse selection dominating. You would not want to give rebate and chase those informed orders.